In this video, I'm going to share with you what amounts limited company directors, give you some examples of amounts company directors can borrow for a residential mortgage. I'm going to explain some of the method and the process that I go through, and also obviously what lenders are looking for. My name is Raj Bogan. I'm a mortgage and life insurance expert for company directors when looking for a residential mortgage. So let's dive into it. What I've got on here on the screen is a set of company accounts. Now, lots going on here, but the main things I'm looking for, you can see here, is looking at profit after tax. Also want to know profit before tax. That's of the company. See, and it's got it for 2 years because we need typically 2 years. Most lenders want to see 2 years of trading and they'll average the income over 2 years. Also, what's really useful, and it's not always on this page, is the dividends that are paid. So in terms of documents, looking for the company accounts, but I'm also looking for something called the tax calculation. It's your personal income, and it's displayed like this. So if you're company director and you paid yourself a salary, you'll have this line here. It says pay from all employments. If you paid yourself a dividend, it's that, then it's a total. So this client in this year, it's not showing the year just quite here because I don't want to share the name, but I can tell you that's 23-24, has earned 40,000. Same client on their accounts as actually, I think it's because the accounts are running to August, as you can see here, and the tax year runs from April to April. It doesn't show the salary on here, but we already know it's 12.5, so it kind of relates to these numbers here. And in this scenario, you can see what I'm looking for is a discrepancy or a difference or a big difference between the profit and the dividends paid. Why? Because most lenders will take the salary and the dividends, which is here, salary and dividends, and then the total is 40. They'll average it over 2 years, and that's what they use as the income. There are a few lenders, and you've maybe heard me talk about this before, we'll use a net profit method. We'll take the salary, which again is 12,500, plus the net profit, which as you can see here is higher, it's 37, plus 12.5 equals 50. Now, I'm not going to complicate too much on this video because they'll actually average the 2 years. I've not got the 2 year tax calculations here. So anyway, so in that scenario, I actually was able to go the lender that used the salary and dividends just because that combined with his partner's income was enough and it got the job done, and we chose the best rate and deal available. But you can see there's not much in it here between the profit and the dividend. So another example, here's someone else's income. They've paid themselves in this particular year, I'm not sure what year it is, doesn't matter. Best part of the salary and dividend is 80,000. However, they own 2 different businesses. So business number 1, you can see here, has made a profit after tax. This is just a draft copy, but don't worry about it, just focus on the numbers. Of 43.5. The previous year was 16.2, so they will average the 2 years. Appreciate I'm only showing you 1 year of tax returns, but it's just to give you the idea. However, business number 2, and this client was looking for over £1 million, by the way. And lenders will typically lend about 4 to 5 times your income, roughly. There's other factors involved in that. If you look at business number 2, see there, 204, 114. So there's a bit of a gap, the average of that, can't work out my head, is like maybe 160 or something. And obviously, and the other thing we can do is some lenders will use the profit before tax. There's not many who will do that. That's why I'm focusing on the after tax figure. But I can combine that figure with some profit from here and the salary, and that's clearly going to be more. As you saw, one of the years there was 200 grand than the 80,000. So with 80,000, if you times that by 4, that's what, 320, 4.5, 360, 5 times is 300,000. Sorry, 400,000. But if you're looking at this figure here, and to be fair, when I spoke to this client, they were due to do the 24 accounts anyway, which were going to be more in line with this. So imagine there's a 24 accounts here with, again, $250,000. $250,000 times 4, if not 5, is like 1.2 million or more. So that's in that scenario, I would choose to use lenders that would use a net profit method because it's going to get that client what they need. There's no way they can borrow that using the salary and dividend method, which most lenders use. Okay, so here's another example. This client wanted to borrow approximately 400,000. Lenders will lend. It depends on your expenditure. If you've got lots of debts, personal debts, etc., there might be childcare, nursery costs. I've seen, there's plenty of clients I deal with that have private school fees. That can obviously reduce what you can borrow. But if there's not too much of that, or it's manageable, it's hard for me to explain that. Lenders will lend, their maximums will be sort of 4.5 to maybe you can get up to 5. You can't even get 5.5 sometimes. But let's just go off about 4.5 as a simple sort of maths. This is the client's personal tax return for 24, just under 50k. This is their previous year. So the reason it's gone down is just purely because he's added his wife to the company, and the accountants advise him to do that, and he can pay some dividends to her. If you look at the accounts, so the average of that is I mean, a lender would actually use the lower of the two, so it'd use the 40 now, the 49,750, because the average is going down. That's 24 and that's 23. That's what they would take. And now with that, let's say 50,000 times that by about 4.5, that's about 225,000. Maximum might be 250 they can borrow. It's not enough. It's not what they need. They need the 400. Like I said, in this year there was some dividends paid to his wife as well. But in this scenario, if you look at the profit of the company, you can see the total dividends paid. Now, to make it a lot simpler, if you average those two numbers together, it comes to 242,000 divided by 2, it's 121, plus the salary. So you can work out even without the salary, 121 is easily you can get to 400. You can get a lot higher than that, so it's boosting the affordability. So that's what I'm looking for. I'm looking at the company accounts versus the personal income, and which is going to work out better for the client. If both methods work, that's fine. We'll just get the lender with the best rate, and it's dead straightforward. But as you start paying higher rate tax on your personal tax, when you start getting over 50,000, if you're watching this and you kind of got that problem yourself, you'll be nodding your head thinking, yeah, I know what you mean. Well, you don't want to start paying massive dividends and paying higher rate tax. So what the heck do you do for a mortgage? Well, this is where we use the net profit method, so you can keep the structure of your business, tax functionality, and what your accountants advised, but at the same time you get the mortgage what you want. And the interest rates, there are less lenders that do it, but the interest rates are still competitive and you're not paying through the nose for it.